Everyone believes charitable giving works the same way. You donate, then you deduct it on your taxes. But what if I told you there's a completely different angle and approach that can allow you to have a greater impact without donating more? Yet almost nobody knows about it. I continue to be amazed at how much money people are leaving on the table with traditional charitable strategies. In the next few minutes, I'm going to reveal exactly what this strategy is, show you real-world scenarios of how much money this can actually save, walk you through the specific rules to make this work, and give you the framework to explore this for your own situation. I'm Bob Wolf, certified financial planner and IRS enrolled agent, and I've spent nearly a decade analyzing financial strategies for the families that I work with. And now I'm bringing that research-driven approach to uncover financial strategies that most people never are told about. Before we go any further, this information is strictly educational and should not be misinterpreted as specific financial, tax, or legal advice. Here's what I started noticing when I analyzed retirement tax patterns. People over 70 and a half are caught in what I like to call the charitable tax trap, and they don't even realize it. Let me paint you a picture of an example. Meet Sarah. She's a composite of patterns I've observed. She's 75 years old. Her required minimum distribution is $25,000, and she faithfully gives $8,000 annually to her church. Her tax preparer does exactly what the majority of preparers do. Takes the full $25,000 of taxable income, then tries to deduct the $8,000 charitable contribution. You see, Sarah needs to take a choice between taking the standard deduction or itemizing her deductions. And with the standard deduction allowing her to take $17,750 as an individual over 65, that $8,000 charitable deduction becomes completely worthless unless she has an additional amount of itemized deductions like mortgage interest, state taxes, or major medical bills to get above that hurdle. She can't use it because the standard deduction is higher, she's paid off her home, and she lives in Florida. So she's paying taxes on $8,000 of income that she immediately gave away and received zero tax benefit for. So let's think about this mathematically. She's being taxed on money she never actually kept. At a 22% tax rate, that's $1,760 in unnecessary taxes, plus it increases her Medicare premiums the following year through income-related monthly adjustment amount surcharges. Now, there's a way that we can get in front of this dilemma by simply restructuring the way that we are giving. And this is through something that is called Qualified Charitable Distributions, or QCDs for short, that flips this equation. The fundamental principle that makes this so powerful is that traditional retirement accounts like IRAs and pre-tax 401ks contain money that was never taxed when you earned it. It was deferred. Similarly, qualified charities don't pay taxes on donations that they receive. So it doesn't matter whether or not you give them after-tax dollars or pre-tax dollars in the eyes of the charity or religious institution, but it certainly matters for you. So when we can shift money directly from our pre-tax accounts to charities, we're essentially moving money from one tax-free entity to another, bypassing your personal tax liability entirely. This often enables your charitable giving to go much further than if you cut a personal check or used other donation methods because you're leveraging the tax-deferred nature of retirement accounts. Instead of the money flowing through your IRA to you and then to charity getting taxed along the way, QCDs create a direct path from IRA directly to the charity. And here is the kicker. The IRS treats this transaction as if you never had it on your return. That being said, it needs to be properly reported in order for us to make sure that we get this benefit. Going back to Sarah's scenario, instead of taking $25,000 as income and trying to deduct $8,000, we restructure it as an $8,000 QCD directly to her church. Now, only $17,000 shows up as taxable income. The result? She saves nearly $2,000 in federal taxes alone, plus keeps her Medicare premiums lower. What I discovered when I dug deeper here is that the strategy creates cascading effects that most people don't necessarily consider. When you're taking required minimum distributions, every dollar that comes out gets added to your adjusted gross income. This can, 1. Push you into higher tax brackets. 2. Trigger Medicare income-related monthly adjustment amount surcharges. 3. Make more of your Social Security benefits taxable. And 4. Affect other income-based benefits and tax credits or deductions. Now that we've talked conceptually about this rule, let's talk about the mechanics of how this actually works and get into the specific rules, because this is where most people can get tripped up and where the strategy can fall apart if you don't understand the details. First off, there's an age requirement. You must be at least 70 and a half when you make the qualified charitable distribution, not when you turn 70 and a half, but actually 70 and a half years old on the day of the distribution. The next criteria is that this needs to be a direct transfer, and this is critical. The money must go directly from your IRA to the charity. You cannot receive the distribution and then donate it. That completely disqualifies the charity, and this is something that is a careful consideration for any sort of in-person giving that we're doing. Next, we have the consideration this is for qualified charities only. It must go to a 501c3 organization, and here's what doesn't qualify: donor-advised funds, private foundations, charitable remainder trust, or any organization where they receive benefits in return. Next up, we have the no benefits rule. You cannot receive any goods or services, no dinner, no auction items, no recognition gifts. The donation must be purely charitable. As for annual limits, the maximum is $108,000 per year as of 2025, and married couples can do up to $216,000 total if they each qualify. Now, in order to ensure that we're properly getting this benefit and reporting it properly, when you file your tax return, you'll report the qualified charitable distribution on lines 4A and 4B of your Form 1040. On line 4A, you would enter your total charitable distributions, including the QCD amount, and on line 4B, you would enter the taxable amount, which is essentially your total distributions minus the QCD amounts. And you would write QCD next to line 4B. This notation is essential as it tells the IRS that part of the distribution was a qualified charitable distribution. Now let's talk about implementing this. You have two main implementation options. Option number 1, you can contact your IRA custodian directly. Most major custodians like Fidelity, Vanguard, Charles Schwab, to name a few, have specific QCD request forms. You'll need the charity's exact legal name, address, and tax ID number. Option number 2 is you can set up a standing letter of authorization if you give the same amount regularly. This may be the easy button, but less flexible. This automates the process for consistent donors. Now again, the critical part that trips up experienced tax professionals and do-it-yourselfers is properly reporting the 1099-R that reports the distribution made from the IRA, which won't show that you made a qualified charitable distribution. It'll just show the total distributions. You and your preparer or your DIY software need to make sure that you're on the same page with this, and you let them know that you've done this throughout the year. Now, as for those that may be looking for additional ways and more sophisticated planning here, QCDs can integrate beautifully with some other strategies. The first strategy would be Roth conversion optimizing. So what we might choose to do is use qualified charitable distributions to lower our income, allowing for larger conversions at the lower tax rates. This creates for a double tax benefit. Next up would be Social Security tax management. So reducing your adjusted gross income through QCDs can help you keep more of your Social Security benefits tax-free by staying below certain taxation thresholds. Next might be Medicare premium optimization. Strategic QCD timing can help you avoid IRMA surcharges, which can save you thousands annually. Another strategy would be estate planning integration. If you're charitably inclined anyway, QCDs can be more tax efficient than leaving money to charity through your estate, which doesn't provide any tax benefits to your heirs. Review your beneficiary designations and see, am I giving as much assets to charity through my pre-tax accounts as I possibly can, rather than having my heirs have to pay taxes on those assets and the charity receive after-tax funds. Now, who should research this strategy and consider investigating it? If you are over 70 and a half or older with traditional IRA or 401k assets, you give money to charity regularly, even in small amounts, you're taking required minimum distributions or other IRA distributions, you want to reduce your taxable income strategically, or maybe you're doing Roth conversions or other tax planning, and this needs to be baked into the overall picture. Even if you're not required to take RMDs yet, qualified charitable distributions can be a powerful, proactive tax planning tool if you're inclined. Here's your action plan for investigating this strategy. First up, contact your IRA custodian and ask specifically about their QCD process and their required forms. Second, I would recommend consulting with a tax professional who understands QCD rules and the implementation so that both parties are on the same page. Third, verify charitable qualifications. Confirm that they're a 501c3 and can receive the QCDs. 4, document everything. Keep detailed records of all QCD transactions. And 5, ensure that you're reporting them properly. Verify your tax return correctly reflects the QCD. And if you've noticed that you may have done this in the past, but it wasn't reported properly, you can always go back up to 3 years and amend your tax return to make sure that you're getting that benefit. Now, the bottom line here is that after analyzing hundreds of retirement tax scenarios, that some of the most powerful strategies are the ones that are hiding in plain sight. QCDs aren't about avoiding taxes that you legitimately owe. They're about not paying taxes the law specifically allows you to avoid. The tax code created this strategy for a reason, but it's up to you to understand and implement it. If you found this video helpful, I'd ask that you share this with somebody who's also charitably inclined so that their dollars can be stretched further without having to give any more from their paycheck. Thanks for tuning in, and I'm looking forward to seeing you in the next video.